Good day, classmates. Our topic for today is about cost and cost control. Listed here are the topics to be discussed: cost definition, natural classification of cost, classification by functions, cost in relation to product, cost in relation to department, cost behavior, period cost, cost planning and control, analytical process in decision making, and cost accumulation. Cost is defined as the amount to be paid for a good or service or the resources given in exchange for such good or services. In commercial terms, the cost is the monetary valuation of the effort, materials, risk, and opportunity cost all put together. Cost is also defined as by the expenditure incurred to produce a given good or service. The cost will be the expenditure that is attributable to something. Value is measured in terms of the usefulness of the product, while the cost is measured strictly in monetary terms. Classification of cost. The first classification of cost is natural classification. This is the analytical classification of cost. So basically, there are three broad categories as per this classification, namely materials cost, labor cost, and expenses. Material costs are the cost of any material we use in the production of goods. For example, let's divide material cost into raw material cost, spare parts, cost of packaging material, and others. Labor cost consists of the salary and wages paid to permanent and temporary employees in the pursuit of the manufacturing of the goods. Lastly, all other expenses associated with making and selling the goods or services. The second classification is by functions. The classification follows the pattern of basic managerial activities of the organization. The grouping of costs is according to the broad divisions of functions, such as production, administration, and selling. Production costs are all costs concerned with actual manufacturing or construction of the goods. These are incurred by a business when it manufactures a product or provides a service. These costs include a variety of expenses. For example, manufacturers have production costs related to the raw materials and labor needed to create the product. Service industries incur production costs related to the labor required to implement the service and any cost of materials involved in delivering the service. Data like the cost of production per unit can help a business set an appropriate sales price for the finished item. Commercial costs, on the other hand, are total cost of the operation of an enterprise other than the manufacturing cost. It includes the admin costs, selling, and distribution costs. The third classification of cost is cost in relation to product. Product costs are costs that are incurred to create a product that is intended for sale to customers. Product costs include direct materials, direct labor, and manufacturing overhead. Direct material costs are the cost of raw materials or parts that go directly into producing products. For example, if Company A is a toy manufacturer, an example of a direct material cost would be the plastic used to make the toys. Second is direct labor. This is the wages, benefits, and insurance that are paid to employees who are directly involved in manufacturing and producing the goods. For example, workers on the assembly line or those who use the machinery to make the products. Lastly, the manufacturing overhead are the costs included in the direct factory-related costs that are incurred when producing a product, such as the cost of machinery and the cost to operate the machinery. Manufacturing overhead costs also include some indirect costs such as indirect materials and indirect labor. Indirect materials are materials that are used in the production process but that are not directly traceable to the product. For example, glue, oil, tape, and cleaning supplies are classified as indirect materials. Indirect labor is the labor of those who are not directly involved in the production of the products. An example would be security guards, supervisors, and quality assurance workers in the factory. Their wages and benefits would be classified as indirect labor cost. Here is a sample problem. Company A produced 1,000 tables. To produce 1,000 tables, the company incurred cost of 20,000 pesos on wood, 50,000 on wages for carpenters, and 10,000 pesos on wages for security guards to overlook the manufacturing facility, 5,000 for a bag of nails to hold the tables together, and 20,000 for factory rent and utilities. So how can we compute the total product cost? So una, i-add po natin yung direct materials which is 20,000 pesos plus 50,000 direct labor. So these are the wages for the carpenters. And 5,000 indirect materials plus 10,000 indirect labor. So these are the sweldo ng security guards to overlook the manufacturing facility. Then plus 20,000 other costs. These are the rent and utilities. So overall, the production cost is 105,000 pesos. As this is the cost to produce 1,000 tables, so we will divide 105,000 production cost divided by 1,000 tables is equal to 105 pesos per table. So yun po yung cost to produce one table, 105 pesos. The fourth classification of cost is the cost in relation to the department. This function within an organization that does not directly add to profit but still cost the organization money to operate, such as the accounting, HR, or IT department. It also tracks actual expenses for comparison to budget. A cost center indirectly contributes to a company's profit through operational efficiency, customer service, or increasing product value. Cost centers help management utilize resources in smarter ways by having a greater understanding of how they are being used. Although cost centers contribute to revenue indirectly, it is impossible to discern the actual revenue generated. Any associated benefits or revenue-producing activities of these departments are disregarded for internal management purposes. The main function of a cost center is to track expenses. The manager of a cost center is only responsible for keeping costs in line with budget and does not bear any responsibility regarding revenue or investment decisions. Expense segmentation into cost centers allows for greater control and analysis of total cost. Accounting for resources at a finer level, such as cost center, allows for more accurate budgets, forecasts, and calculations based on future changes. Fifth is the cost behavior. Cost behavior is the manner in which expenses are impacted by changes in business activity. The general types of cost behavior fall into three categories. First is variable cost, which vary directly with changes in business activity. For example, there is a specific direct materials cost associated with each product sold. Second is fixed cost. This is a cost that do not change in response to business activity levels. For example, the rent on a building will not change even if the sales level of the tenant changes dramatically. Finally, there is the mixed cost, which contain fixed and variable elements. For example, an internal access fee includes a standard monthly access fee, which is fixed, and a broadband usage fee, which is variable. The sixth classification of cost is the accounting cost or the period cost. A period cost is any cost that cannot be capitalized into prepaid expenses, inventory, or fixed assets. Samples of period costs are selling expenses, advertising expenses, travel and entertainment expenses, commissions, depreciation expense, general and administrative expense, executive and administrative salaries and benefits, office rent, and interest expense that is not capitalized into a fixed asset. Number 7, cost planning and control. This is an estimation of cost, the setting of an agreed budget, and management of actual and forecast cost against the budget. Cost planning is an essential part of the project management process. Project managers need to understand where costs fall in their schedule to manage demand for resources. Typically, all resources that consume cost will be included in a resource optimized schedule. This type of schedule is essential to cost planning to help build a picture of planned cost over time. Planned cost can be fixed or variable. A fixed cost happens once in the life of a project, for example, a machine setup. A variable cost happens more than once over the life of a project, for example, is a component machining. Cost control is the process of collecting actual costs and collating them in a format to allow comparison with project budgets. Cost control is necessary to keep a record of monetary expenditure for purposes such as minimizing cost where possible, revealing areas of cost overspend. Its information is fundamental to the lessons learned process, as it can provide a database of actual cost against activities and work packages that be used to inform future projects. Number 8, analytical process for decision making. Cost-benefit analysis is a systematic process that businesses use to analyze which decisions to make and which to forego. A cost-benefit analysis sums the potential rewards expected from a situation or action and then subtracts the total cost associated with taking that action. Some consultants or analysts also build models to assign a dollar value on intangible items, such as the benefits and costs associated with living in a certain town. For example, before building a new plant or taking on a new project, prudent managers conduct a cost-benefit analysis to evaluate all the potential costs and revenues that a company might generate from the project. The outcome of the analysis will determine whether the project is financially feasible or if the company should pursue another project. In many models, a cost-benefit analysis will also factor the opportunity cost into the decision-making process. Opportunity costs are alternative benefits that could have been realized when choosing one alternative over another. In other words, the opportunity cost is the foregone or missed opportunity as a result of a choice or decision. Factoring in opportunity cost allows project managers to weigh the benefits from alternative courses of action and not merely the current path or choice being considered in the cost-benefit analysis. By considering all options and the potential missed opportunities, the cost-benefit analysis is more thorough and allows for better decision making. The costs involved in a CBA might include the following. Direct costs would be direct labor involved in manufacturing, inventory, raw materials, and manufacturing expenses. Indirect costs might include electricity, overhead costs from management, rent, utilities. Intangible cost of a decision, such as the impact on customers, employees, or delivery times. Opportunity costs such as alternative investment or buying a plant versus building one. Cost of potential risk such as regulatory risk, competition, and environmental impacts. Cost accumulation. This involves the use of a formal cost accounting system to collect cost information. By collecting and analyzing cost information, management can make more informed decisions about the operations of a business. Cost accumulation systems fall into two main categories, which are number 1, job cost system. A job cost system accumulates materials, labor, and overhead costs about individual jobs. It is designed for production processes that create products in smaller batches. It is a costing method used to determine the cost of a specific jobs, which are performed according to the customer specifications. It is a basic costing method which is applicable where work consists of separate projects or contract jobs. Generally, the application of job costing method is followed in industries such as printing press, automobile garage, repair workshops, shipbuilding, foundry, and other similar manufacturing units, which manufactures according to customer-specific requirements. These are the features of job costing. Using job costing, the cost of each job is ascertained separately. This in turn helps in finding out the profit or loss on each job. It enables management to detect those jobs which are more profitable and unprofitable ones. Job costing provides the base for determining the cost of similar jobs to be undertaken in future as a part of future planning. Helps in managing and controlling cost by comparing the actual cost with the estimated cost. In short, the calculation of variances. Process system accumulate costs by cost center and then assigns average cost to products. It is designed for production processes that create large quantities of units over an extended period of time. Process costing is an accounting method typically used by companies that mass produce very similar or identical products or units of outputs. It's common in manufacturing industries where the cost of producing each unit of output are very similar, and it doesn't make sense to try to track cost for each individual until throughout unit throughout the production process. For example, process costing is used by oil companies that produce millions of gallons of fuel and by processed food companies that make millions of identical packages of snacks. Process costing is particularly important in the oil, chemical, lumber, textile, and food processing industries. Getting a handle on production cost enables these companies to set the right prices for their products and determine whether costs are tracking in line with projections. They can use process costing to analyze the cost of each step of the production and distribution process and use the information to identify areas where they can reduce costs. Direct costing is a specialized form of cost analysis that only uses variable costs to make decisions. It does not consider fixed costs, which are assumed to be associated with the time periods in which they were incurred. The direct costing concept is extremely useful for short-term decisions, but can lead to harmful results if used for long-term decision-making, since it does not include all costs that may apply for longer-term decisions. In brief, direct costing is the analysis of incremental cost. A direct cost statement is a cost statement that includes only those expenses that relate directly to the implementation of a project, such as the cost of labor and materials. A full cost statement, on the other hand, considers all costs associated with a particular venture, such as environmental or social expenses. A direct cost statement is usually shorter than a full cost statement. Full costing is used to determine the complete and entire cost of something. The concept is most commonly used for recording the full cost of inventory in the financial statements. This type of costing is required for financial reporting under several accounting frameworks, such as generally accepted accounting principles and international financial reporting standards, as well as for income tax reporting. Full costing is also called absorption costing. This method of costing allocates manufacturing costs, including variable costs like raw materials and fixed costs like machinery and buildings, to individual finished goods. Full costing is an accounting method used to determine the complete end-to-end cost of producing products or services. When using the full costing method, all direct, fixed, and variable overhead costs are assigned to the end project. The essential concept behind full costing is to assign all variable costs to a cost object. as well as an allocation of overhead cost. A cost object is anything about which cost information is collected, such as a customer, product, service, store, geographic region, product line, and so on. These are the pros and cons of full costing and direct costing. A full costing income statement attempts to achieve clarity by grouping all the costs associated with the manufacture of a product together and thus reflecting gross margin. While this is easy to visualize on the income statement, it brings with it the challenge that costs are invisible until sales occur. Pros and cons of direct costing. Direct costing has the advantage of smoothing out the fixed overhead associated with manufacturing over the periods of the year. This helps accurately reflect the fact that there is a constant level of cost associated with running a manufacturing facility, whether anything is sold or not. It is a significant tool for internal decision making, especially when it comes to deciding whether to close an unprofitable factory or product line. By comparing the variable cost of producing one unit that can be sold to the fixed cost of keeping the facility open, management has information that helps determine pricing, production, and staffing volume, sales goals, and expansion or contraction decisions. Direct costing contrasted with full costing. The difference between full costing and variable costing or the direct costing income statement lies in the way that each deals with fixed manufacturing overhead costs. Each has its own benefits and drawbacks. Each company must decide which method provides the best information for internal decision makers. A direct costing income statement is one in which all variable expenses are deducted from revenue to arrive at a separately stated contribution margin, from which all expenses are then subtracted to arrive at the net profit or loss for the period. Here is another sample problem. Bradley Company had the following information for May. Direct materials 13,000, direct labor 15,000, variable overhead 5,000, fixed overhead 6,000, fixed selling expenses 15,000, variable selling expense 20.20 per unit, administrative expense 12,000, 10,000 units were produced and 9,000 units were sold. 1,000 remaining in ending finished goods inventory. The sales price per unit is 8 pesos. First, we compute for the product cost per unit. So how can we compute that? First, we add the direct materials with the direct labor, variable overhead to come up with the product cost. So 13,000 plus 15 plus 5,000 is equal to 33,000. We divide it by the units produced, which is 10,000. So the product cost per unit is 3.3. So we can come up now with the income statement of Bradley Company. First, we can compute for the sales. So how many units were sold? It's 9,000 times 8 sales price per unit. So 8 times 9,000 is 72,000 less the cost of goods sold, which is 9,000 units sold times 3.3, which is the product cost per unit, is equal to 29,700. Add the selling expenses. So 9,000 units sold times 50.2 per unit is equal to 1,800. So we add that together, we come up with 31,500 total variable cost. We subtract this from the sales, which is 72,000. We come up with 40,500 contribution margin. We then again subtract the following fixed cost, fixed overhead, which is the fixed portion only, 6,000, and the selling expense, fixed portion ulit, which is 15,000. Then we add the administrative expenses, which is 12,000. We add it all together. 33,000. We subtract this from 40,500 contribution margin. We come up with a net operating income of 7,500. Conventional income statement. This approach is the dominant format used by nearly all companies because it is required by the accounting standards for the reporting of financial results to outside parties. Because the traditional income statement involves the use of cost allocations within the cost of goods sold block of information, it can be difficult to determine which costs vary with changes in sales. A conventional income statement uses absorption or full costing, where both variable and fixed manufacturing costs are included when calculating the cost of goods sold. Another sample problem for the conventional income statement. So these are the given for this problem. When doing an income statement, the first thing you always do is calculate the cost per unit. Under absorption costing, the cost per unit is direct materials, direct labor, variable overhead, and fixed overhead. In this case, the fixed overhead per unit is calculated by dividing total fixed overhead by the number of units produced. So, ito, yung fixed overhead, which is 48,000, divided by units produced, which is 10,000. So, we came up with a fixed overhead unit price, which is 4.8. So, we add all of them, we come up with 48.8. Once you have the cost per unit, the rest of the statement is fairly easy to complete. All variable items are calculated based on the number of units sold. This includes sales, cost of goods sold, and the variable piece of selling and administrative expenses. The matching principle states that we must match revenue with expenses. Therefore, we can only expense the cost of the units that are sold. The units that are not sold end up in inventory. So we start with the sales. So sales units sold is 8,000 times 100 sales price is 800,000. Next, we compute for the cost of goods sold. So the one we computed, the unit price per product cost is 48.8 times the 8,000 units sold, we got 390,400. Ngayon, i-deduct na natin to sa sales. So, may gross profit tayo na 409,600. Then, ililess na natin yung selling and administrative cost. This includes the variable selling, the fixed overhead, and the fixed selling and administrative cost. Selling and administrative expense can be variable or fixed. Therefore, we should treat the selling and administrative cost like a mixed cost. In this case, the variable rate is 5 per unit. Variable selling is 5 per unit, and the fixed cost is 112,000. So we add that together. Yung variable selling per unit is 5 times 8,000 units sold plus 112,000. We came up with total selling and administrative expenses. So 152,000. Dideduct po ulit natin kay gross profit na 409,600. Then we come up with the operating income of 257,600 pesos. So that's how you compute the conventional income statement are computed. So the last topic is direct costing in profit planning. Direct costing facilitates the compilation of profit planning data, which cost departments have always developed, often at a great expenditure of time and effort, long before the advent of the present direct costing structures. Forecasting of cost and contribution margins, flexible budget analysis, relationship of cost to sales volume and sales price, and many other cost relationships can be readily studied. Marketing department managers have been using variable costing in setting selling prices for many years. The understanding of contribution margin and sales pricing is one of the first things they must learn if they are to be successful. The reports are more directly related to the profit objective or budget for the period. So this ends my report about cost and cost control. Thank you for listening and have a good day.